Welcome to the deep dive. Today we're tackling commodities and commodity derivatives. Think oil, gold, corn, that kind of stuff.
Yeah, the physical goods.
Exactly. We've gathered a bunch of material to really dig into this unique asset class and pull out the key insights for you.
Our mission, really, is to give you a solid foundation, how commodities work, how they're valued, the markets involved.
And what makes them different, right? They're
Like,
not like stocks or bonds.
not at all. Mostly physical goods, tied to natural resources. Stocks and bonds are claims on future cash flows, productive capital.
But commodities, their value comes from being used?
Pretty much. Consumption or as inputs for making other things. That's the core value proposition.
And the main place people trade these manage the risk.
That's overwhelmingly the futures market. There are spot markets, yeah, for immediate delivery and forwards, swaps. But futures are central.
So we'll focus mostly there today.
Makes sense. And, one big reason people look at commodities is diversification potential. Right. They don't always move in sync with stocks and bonds historically.
Exactly. Low correlation, historically speaking. Plus, they can potentially act as an inflation hedge.
Which is definitely topical. Okay, so roadmap for today.
We'll look at the different commodity sectors first.
Then their life cycles, how they're valued different from equities you mentioned.
Right. Then who's playing in the futures markets? Spot versus futures pricing.
Contango, backwardation, got to cover those.
Absolutely. Theories behind futures returns, what makes up the total return, commodity swaps, and finally, commodity indexes.
Okay, quite a bit to cover. Let's start with the sectors. What are the main buckets?
Generally think energy, grains, industrial metals like copper, aluminum, livestock, precious metals, and then soft.
Softs like coffee, sugar.
Exactly, cash crops.
Yeah.
That's how major benchmarks like the Bloomberg Commodity Index categorize them. And what's really interesting is how different the drivers are for each.
Right. Take energy, oil, gas. Availability depends on what? New discoveries. Discoveries, yeah, how easy it is to extract, refinery tech, even overall economic growth, GDP.
And getting it where it needs to go, the flow.
That's pipelines, tanker reliability, seasonal demand, heating oil versus gasoline weather, geopolitics. It's complex.
Okay, contrast that with grains, wheat, corn.
Very different. Supply, the stock, depends heavily on arable land, storage infrastructure.
And demand, the flow.
Oh, that's weather, massively. Chronic diseases, changing taste, GMOs, biofuel demand, lots of factors.
Okay, then industrial metals. Copper, you mentioned.
Yeah. Supply is about mining output, smelter capacity. Demand is really tied to the economy, GDP growth, big infrastructure projects, car manufacturing.
Makes sense. Livestock, hogs, cattle.
They have their own rhythm. Herd size dictates supply, processing capacity too. Demand links to how fast they mature, incomes, disease, feed costs.
Feed costs driven by weather sometimes too, right?
Absolutely. It's all interconnected. Precious metals, gold, silver.
Often seen as safe havens, aren't they?
They are. Supply is mining, but demand is heavily influenced by things like central bank buying, geopolitical uncertainty, inflation fears.
Got it. And finally, softs, coffee, sugar, cotton.
Similar to grains, in some ways, supply tied to land, storage, demand influenced by weather, disease, consumer preferences, biofuels again, income levels.
Wow. Okay. So with all these different drivers, how do analysts actually try to predict prices?
It's a mix. You've got direct announcements like from OPEC or the USDA on production numbers.
Official figures?
Right. Then component analysis breaking down supply and demand into those stock and flow factors we just discussed.
Timing must be huge too. Seasonality.
Crucial. Seasonality, logistics, unexpected shocks like weather events or political crises. And then there's the money flow aspect.
Meaning investor sentiment?
Sentiment, yeah, but also broader macro stuff. Inflation, interest rates, government subsidies can play a role too.
Okay, so if industrial activity is booming, that probably means higher demand for copper.
Exactly. Copper is often called Dr. Copper because it's seen as a barometer of economic health.
Whereas gold
Yeah.
may be less affected by short-term weather.
Much less. It's easy to store, its demand drivers are different, more financial, geopolitical.
Okay, that makes sense. Let's shift to the life cycles. It's not like making a product in a factory.
No, it varies a lot. How fast supply and demand can adjust depends heavily on that life cycle. Agriculture and livestock have really defined seasons, tied to geography.
Like planting in the northern hemisphere versus the southern?
Precisely. It's a natural rhythm.
Whereas energy and metals.
More continuous extraction year-round, mostly. Changes happen more at the margin of ongoing operations.
The demand can still be seasonal.
Oh, yeah. Think summer driving season for gasoline, Winter heating oil demand. Metal usage can fluctuate with construction seasons, too.
You mentioned earlier it's hard for, say, copper producers to just cut back production quickly if demand drops. Why is that?
It often comes down to huge economies of scale. Smelters, refineries, these are massive capital-intensive operations.
High fixed costs?
Very high. So the cost per ton drops significantly the closer they run to full capacity. Shutting down and restarting is expensive. They might keep producing even if prices are weak, hoping to outlast competitors.
A bit of a game of chicken.
Can be. And livestock, they have their own biological timelines, right?
Yeah, how long does it take?
Well, hogs are about 6 months from birth to market weight. Cattle take much longer grazing than feedlots.
And technology's changed things, like freezing.
Massively. Cryogenic tech really opened up global meat exports, overcoming spoilage issues that used to limit trade, especially for the U.S. historically.
So it's the whole chain: growing, processing, storing, shipping.
Exactly. Grains in the northern hemisphere, you've got planting, growing, grain fill, harvest. Storage is vital because demand is year-round.
And coffee.
Similar journey, harvesting cherries, processing beans, wet or dry methods, shipping, storage, roasting. Futures contracts for Arabica and Robusta help manage price risk along that whole chain.
This feels fundamentally different from valuing a stock.
It absolutely is. Stocks and bonds, you're looking at claims on future earnings, future cash flows. You discount those back.
Right, DCF models and the like.
Commodities. They're mostly physical things. Their value is intrinsic, economic, tied to use. They don't just generate cash flow sitting there.
So how do you value a barrel of oil then?
It really boils down to forecasting future prices based on supply and demand dynamics, and expected price volatility plays a role too.
Less about discounting cash flows, more about forecasting the balance of the physical market.
That's the core idea. Plus, you have to factor in costs like transport and storage.
Ah, right. How do they affect prices?
Generally, those costs tend to mean futures prices for later delivery dates are incrementally higher. It costs money to hold the stuff.
That makes sense. Storage isn't free.
But if current demand is incredibly strong, maybe there's a shorting right now, you can see spot prices actually go higher than futures prices.
Okay, so the relationship isn't fixed.
Not at all. And this interplay between time, storage costs, and supply demand gives rise to something called roll return or roll yield, which we'll definitely dig into more.
And I guess the fact that not everyone trading futures can actually, take delivery of a tanker of oil complicates things.
That's a really key point. It means the link between spot and futures isn't always perfectly tight. Arbitrage is harder. It's more of a range sometimes.
But the futures market is still crucial for figuring out prices.
Absolutely. Price discovery is a major function. In risk management, think of an airline using jet fuel futures to hedge its fuel costs. That helps them price tickets.
Okay, so bottom line, stock bond valuation, discounted cash flows, commodity valuation, supply, demand, storage costs, convenience.
And investment is mostly via derivatives, especially futures.
Got it. Okay, let's talk about who's actually in these futures markets. It's not just farmers and airlines, right?
Oh, no, far from it.
Yeah.
Public markets for futures exchanges, centralized places, standardized contracts, great for risk transfer and price discovery.
Standardized is key, unlike forwards.
Exactly. Forwards are typically OTC, customized between two parties. Futures are standardized, traded on exchange, marked to market daily. Less counterparty risk.
That's why they evolved, right? To reduce default risk.
Largely, yes. An interesting feature is that futures markets are net zero. For every long position, there's a short position.
Unlike stocks, where there's a net long bias overall.
Right. And going short in futures is generally much simpler mechanically than shorting stock.
So who are the main players?
Broadly, you've got hedgers. These are the commercial folks, producers, consumers using futures to manage price risk in their actual business.
Like that farmer selling corn futures, or the airline buying jet fuel futures.
Precisely. And hedging doesn't automatically mean short or long. It depends on their underlying exposure. A consumer hedges by buying, a producer by selling.
Okay, who else?
Speculators. This is a really broad group. Traders, investors, index funds, they're betting on price direction or volatility, hoping to profit.
And they provide liquidity.
Crucial role. They make it easier for hedgers to get their trades done. Within speculators, you have informed investors doing deep analysis, pure liquidity providers just making markets, and arbitrageurs trying to exploit tiny price differences, sometimes involving physical inventory.
And the exchanges themselves.
Exchanges and clearinghouses are participants. In a sense, they set rules, provide infrastructure, guarantee trades. Then you have analysts providing research, forecasts.
Not necessarily trading themselves.
Right, using info for business decisions, policy, etc. Brokers fit here too. And finally, regulators CFTC in the US, others globally overseeing the markets.
So those liquidity providers, the speculators, they're sort of providing insurance to the hedgers by taking the other side.
That's a good way to think about it. They're taking on price risk, expecting to be compensated for it.
Okay, let's get deeper into spot versus futures prices. You mentioned contango and backwardation.
Right. Spot price. Price for immediate physical delivery. Futures price. Agreed price today for future delivery. The difference is the basis.
Basis, spot, futures.
Usually defined that way, yeah.
Okay.
And this basis changes.
Sometimes spot is higher, sometimes lower.
Exactly. When spot is higher than futures or near-term futures are pricier than longer-term ones, that's backwardation.
Okay, spot higher equals backwardation.
And the opposite spot, lower than futures or near-term cheaper than longer-term, that's contango.
Contango sounds like continue, like the price continues higher further out.
That's one way to remember it. It's thought to relate historically to the costs of carrying the commodity, forward storage, insurance, interest.
And the difference between two futures contracts,
Yeah.
like December corn versus March corn.
That's a calendar spread. In contango, that spread is usually negative. Further out is more expensive. In backwardation, it's positive. Further out is cheaper.
Why would a producer sell futures at a lower price than spot? Backwardation.
Certainty. Locking in a price today avoids the risk of prices falling even further.
And the speculator buying that contract.
Hopes the spot price stays high or rises so the futures price converges upwards towards it. In contango, though, if you're long futures,
Your contract price tends to drift down towards the lower spot price as expiry nears. That sounds like a drag.
it can be. It erodes value if you're just holding long futures in contango and rolling them.
We had examples. WTI crude was in backwardation in one exhibit.
Right, downward sloping curve, near prices higher than far prices. Lean hogs were in contango.
Upward sloping curve near prices lower than far. Got it. And settlement. It's not always physical delivery.
Increasingly, it's cash settlement based on the price difference. This opened the market to many more participants who didn't want to handle physical barrels or bushels.
But the possibility of physical delivery is what links futures to the spot market.
Exactly. It ensures convergence at expiration. These markets aren't just for trading. They provide vital signals for hedging, inventory decisions, even government policy.
Okay, so if July oil is above August oil, that's backwardation.
Yep.
And if the corn-March corn spread is negative,
That implies contango. And remember, markets can flip between these states.
based on supply and demand shifts. Okay, let's talk about why these curves take these shapes. The theories.
Right. There are three main ones we should cover: insurance theory, hedging pressure hypothesis, and the theory of storage.
Insurance theory. That's Keynes, and normal backwardation.
That's the one. Keynes argued producers are natural sellers of futures, hedgers. This selling pressure pushes futures prices below the expected future spot price.
Creating backwardation.
Right. Speculators buy these discounted futures, providing insurance, and expect to earn a risk premium as the price rises towards the spot price at expiry.
Makes sense. But does it always happen?
Well, empirical evidence is mixed. Kolb famously found that normal backwardation is not normal, meaning it's not a consistent phenomenon across all commodities or time periods.
Okay, so theory 2, hedging pressure.
This expands on Keynes by acknowledging that consumers also hedge by buying futures to lock in prices.
So you have pressure from both sides.
Exactly. If producers selling pressure equals consumer buying pressure, maybe you get a flat curve. If producers dominate hedging,
More selling pressure. Backwardation.
likely. If consumers dominate, more buying pressure.
Pushes future prices up. Contango.
That's the idea. The challenge is actually measuring this hedging pressure asymmetry in real time. It's tough.
Makes sense. Okay, third theory. Theory of storage.
Developed by Koldor. This one focuses on inventory levels. High inventories mean high storage costs.
Which need to be reflected in higher future prices, leading to contango.
Exactly. Conversely, very low inventories, maybe a just-in-time situation, can lead to backwardation. People will pay a premium for immediate availability.
This brings in convenience yield.
Right. That's the benefit of having the physical stuff on hand right now. Avoids shutdowns, meets unexpected demand. The basic formula is futures price. Spot price plus storage costs convenience yield.
So high convenience yield means
Backwardation is more likely. Think of an oil supply disruption like Libya in 2011. The convenience yield for readily available oil spiked, pushing the market into backwardation.
But calculating storage costs and especially convenience yield reliably is hard.
Very difficult. So each theory offers a lens, but none is a perfect predictor on its own.
Okay, let's move to total return for futures investors.
Mm.
It's not just the price change, right?
Correct. Holding futures isn't like holding the physical asset due to storage, rolling contracts, etc. Total return has three key parts:
Which are?
price return, roll return, and collateral return.
Price return is just the change in the futures contract price, usually the front month.
Yeah, the percentage change in that near-term contract price captures market direction.
Okay, then roll return. That comes from.
From rolling the position. As the front month contract nears expiry, you sell it and buy the next contract out.
Right, to maintain exposure.
And the price difference between the contract you sell and the one you buy generates the roll return or roll yield.
So in backwardation, futures prices are lower further out.
Right.
So when you roll, you sell the higher price near contract and buy the lower price further contract.
Exactly. That generates a positive roll return.
And in contango, future prices are higher.
Yep. So you sell the cheaper near contract and buy the more expensive further contract.
Which means a negative roll return. It costs you money to roll.
Precisely. Think of that gasoline example.
Right.
Sell at £9, buy at £10. That's a £1 negative roll impact per unit, ignoring other factors for simplicity. We saw a negative roll return example with WTI crude in contango too.
And this roll return, it's not something you can trade separately. It's embedded in the total return.
It's essentially an accounting calculation, particularly important for fully collateralized indexes that systematically roll positions. Whether it represents a true risk premium is debated.
Okay. And the third component, collateral return.
Simple enough. Futures are margined, so you post collateral, usually cash or T-bills. You earn interest on that collateral.
So it's basically the risk-free rate earned on the capital backing the position.
That's it. And historically, looking at indexes like the S&P GSCI, collateral return has often been a pretty significant chunk of the total return.
More than people might think.
Yeah.
And roll return for broad indexes has often been.
Historically negative on average for something like the GSCI, reflecting periods of contango in major components.
Okay, so just to nail it down, backwardation, positive roll return, usually. Contango, negative roll return, usually.
That's the general tendency. And remember, these are outcomes of supply demand, storage costs, convenience yield. They reflect the market's pricing of time for that commodity.
And looking at historical data, contango and backwardation aren't permanent states, right? Markets shift.
Absolutely. And roll return isn't always strongly correlated with the price return itself. They can move differently.
Do different sectors tend to behave differently regarding roll return?
Yes, definitely. Historically, sectors like industrial metals, agriculture, livestock, even precious metals have tended to show negative average roll returns.
Why is that? Storage costs.
Storage costs are a big part of it for many. For precious metals, it might also relate to their role as alternative currency or store of value. Energy has been more variable.
Used to have positive roll yield sometimes.
Yeah, potentially linked to convenience yield being high. But things like shale oil production and OPEC actions have changed the dynamics, making positive roll less common recently.
So if you're investing in an index weighted heavily towards sectors with historically negative roll returns,
You should probably expect that to be a bit of a drag on performance over time. It's very sector dependent.
but in any single period, roll return could be quite significant, even if it averages out modestly over the long run.
Exactly. It can definitely impact short-term returns.
Okay, let's pivot to commodity swaps. How are they different from futures?
Swaps are private agreements, usually OTC, to exchange payments based on a commodity price or index over time, often based on futures prices, but more flexible.
So more customization possible.
That's the main advantage. You can tailor them to specific needs, a particular grade of oil, specific dates, etc., without managing multiple futures contracts directly.
Like that oil refiner example, they could use a swap to lock in costs for a specific type of crude they use.
Precisely. They might agree to pay a fixed price and receive payments based on a floating benchmark price, hedging their input cost. It involves dealers who structure these deals, often offsetting their risk with other swaps.
What kinds of swaps are common?
Several types. An excess return swap just exchanges payments based on the change in the underlying futures price.
Simple price exposure.
Right. A total return swap is more common for investors. One side pays the total return of a commodity index price plus collateral return.
And receives what? A fixed or floating rate payment?
Usually something like LIBOR or SOFR plus or minus a spread. Institutions use these for broad commodity exposure, diversification, inflation hedging.
Makes sense for a pension fund, maybe.
Good example. Then there are basis swaps exchanging payments based on the difference between two related prices.
Like Brent oil versus some U.S. grade.
Exactly, if you have a view on that spread changing. And finally, volatility swaps betting on realized volatility versus expected volatility.
So total return swap gives index exposure easily. Basis swap is for relative value plays.
You got it.
Okay, last major topic. Commodity indexes. Lots of them out there. What do they do?
They serve multiple roles. Benchmarks for performance, macroeconomic indicators, and the basis for investment products like ETFs or swaps.
You mentioned S&P, GSCI, Bloomberg BCOM, DBLCI, CRB, RICI.
Those are the big ones, yeah.
What makes them different? They don't all perform the same.
No, they don't, because they differ in several key ways. First, coverage, how many commodities, which sectors.
Weighting methodology must be huge.
Absolutely. How much weight each commodity gets. GSCI is production weighted, often heavy in energy. Others use fixed weights or liquidity screens.
And how they roll contracts. That affects roll return.
Definitely. Some roll front-month contracts, others might roll further out. Some have optimized rolling strategies like the DBLCI, trying to maximize backwardation or minimize contango impact.
Rebalancing, too, how often they adjust weights.
Right. Frequency and methodology matter. Fixed weights need more rebalancing than floating weights. And finally, governance rules-based versus committee decisions. Investability is key, too. Can you actually replicate the index?
So GSCI is production weighted, maybe concentrated. DBLCI has that optimized roll. TRCC CRB uses a committee, tiered weights. RICI is very broad, fixed weights, can have FX exposure.
That's a good summary of some key differences. Rebalancing frequency can matter too. More frequent might be better in choppy mean reverting markets, less frequent in trending markets.
So there's no single best index.
Not really. Performance depends on the market environment and the index construction. They tend to be highly correlated with each other, though.
But still have low correlation to stocks and bonds.
Generally, yes, that diversification benefit persists across most broad commodity indexes.
Okay, well, that was definitely a deep dive into commodities.
We covered a lot of ground, didn't we? Sectors, life cycles, valuation differences, market players, spot versus futures, contango, backwardation.
Theories of return, the components of return, like roll yields, swaps, indexes.
Hopefully giving you a good handle on how this asset class works.
And highlighting that diversification and potential inflation hedging role.
Absolutely. So maybe a final thought to leave you with.
Go for it.
Really consider how the physical nature of most commodities fundamentally separates them from financial assets. How do storage, transportation, seasonality, actual consumption needs create risks and opportunities you just don't see in stocks or bonds?
And how things like geopolitics or climate change constantly reshape those supply and demand dynamics we talked about.
Exactly. It's a constantly evolving space. Maybe this dive sparks interest in looking deeper into one particular sector, energy, agriculture, metals, based on what drives its specific cycle.
Lots to think about. Thanks for joining us on the Deep Dive.